Hey everyone, welcome back to the channel. Today we're breaking down one of the most talked about income ETFs on the market, the NEOS S&P 500 High Income ETF, ticker symbol SPYI. If you've been searching for a way to earn high monthly income while still getting exposure to the S&P 500, this one's for you. SPYI is an exchange-traded fund launched by NEOS Investments on August 30th, 2022. It's designed to provide tax-efficient, high monthly income while investing primarily in large-cap U.S. equities, basically the biggest names in the S&P 500. But here's the twist. SPYI doesn't just hold stocks. It also uses an option strategy, selling call spreads on the S&P 500 index to generate additional income. That's how it manages to offer such a massive yield without completely giving up exposure to market upside. As of October 17, 2025, SPYI traded around $52.21, up about 0.56% for the day, and even a bit higher in after hours. It has $5.72 billion in assets under management and about 110 million shares outstanding. The expense ratio is 0.68%, a bit higher than passive ETFs like VO, but remember, this fund is actively managed. Its dividend yield? An incredible 11.73%, with monthly payouts averaging around 50 cents to 52 cents per share in recent months. The latest ex-dividend date was September 24, 2025, and the payout was $0.527. SPYI's portfolio mirrors the S&P 500, so you'll see familiar names dominating the top spots. Its top 10 holdings make up about 38.9% of total assets, led by NVIDIA, 7.85%, Microsoft, MSFD, 6.76%, Apple, APL, 6.52%, Amazon, AMZN, 3.68%, Broadcom, AVGO, 2.95%, Meta, 2.73%. Alphabet, Google, and Google, a combined 4.67%. Tesla, TSLA, 2.12%. Berkshire Hathaway, BRK.B, 1.59%. So while SPYI's strategy centers on income, its core is still tech-heavy, just like the broader S&P 500. In the past year, SPYI delivered a 13.7% total return, including dividends. Since inception, its average annual return is around 14.3%. Not bad for a fund that's prioritizing income. And with a beta of 0.71, it's less volatile than the overall market. So you're getting strong income and a smoother ride through market swings. Here's the secret sauce. SPYI uses S&P 500 index call options, specifically SPX call spreads, to generate cash flow. Every month, it sells slightly out-of-the-money calls to collect premiums, then buys a higher strike call to cap risk. That income gets passed along to investors as monthly distributions. It's similar to what funds like JEPI or QYLD do, but NEOS focuses on tax efficiency and option structure optimization to squeeze out higher after-tax yields. Not everyone's convinced, though. Some analysts argue SPYI sacrifices long-term growth for short-term income, and that its yield may not be sustainable if markets flatten out. Others point out that the 324% payout ratio means the fund sometimes returns capital instead of pure income. Still, compared to peers like JEPI, QYLD, and GPIX, SPYI has outperformed in total return, yield consistency, and tax efficiency since launch. So depending on your priorities, monthly cash flow versus capital growth, it can still make a compelling case. The NEOS S&P 500 High Income ETF is carving out its place as a premium income ETF for investors who want exposure to U.S. large caps without the boring yields of traditional dividend ETFs. With an 11 to 12% yield, monthly distributions, and strong AUM growth, it's clearly found a loyal investor base. Just remember, that income comes with a trade-off: less upside in bull markets. If you're an income-focused investor looking to supplement your portfolio with steady monthly cash flow, especially in a tax-smart way, SPYI deserve a closer look. So what do you think? Is SPYI a long-term hold or just a short-term income play? Drop your thoughts in the comments below. Don't forget to hit like, subscribe, and ring that notification bell for more ETF deep dives. Thanks for watching, and I'll see you in the next video.